Today I'm going to take my fellow first responders deep into the details of buying a home with a loan. And I'm going to break it down into 3 phases. Be sure to watch to the end because I'm going to talk about a very sad pitfall that many home buyers fall into. And it's really unfortunate because not only did they lose out on their new home deal, but it caused them to lose their earnest money and inspection money, which is a couple $1,000s as well. But don't worry too much because I'm actually going to show you how to avoid that. So stick around to the end. Stay tuned. This is Steve Dooley. Hey, it's Steve Dooley, where we provide our first responder personnel with great information about buying, selling, investing, well, everything real estate. Be sure to subscribe and ring the bell so you don't miss out on any of these great tactics and strategies that we'll be delivering on a regular basis. You may know some stuff about the buying process. Heck, maybe even watch my other video. You may know things about like earnest money, 10-day inspection periods, appraisals and whatnot. But there's probably a lot of stuff you don't know about kind of what goes on in the background about the entire loan process, how the loan's done and everything else. And that's what we're going to talk about today. So let's go ahead and dive in to buying a home using a loan. So one of the first steps in the buying process is getting pre-qualified or pre-approved. And there's actually a couple steps in doing that. So the first thing you'll probably do is either reach out by yourself on your own to a lender, or if you are working with a real estate agent, they'll definitely connect you with a lender that they work with. That's always a really good idea because the lender works closely with the agent throughout the transaction. So the very first thing you'll do is probably have a phone conversation with the lender, and they'll talk about your credit score and your income and ask you several questions regarding your financial situation just to get a feel for where you're at. Then they can either take your application, your loan application over the phone, or they can direct you to like an online portal where you could just submit the information. Most of them will do either, whatever you're more comfortable with. So the first step in that pre-approval process is getting your loan application done with the lender. So when your lender is getting your loan application and you've submitted things on their portal or either over the phone, they'll run your credit, and based off your income and your credit score, they can get you what's called getting pre-qualified. Now, I just want to kind of touch on the differences. Getting pre-qualified and getting pre-approved are 2 different ballparks. You can place offers depending on how comfortable the lender is with your financial situation. If you're just pre-qualified, you can get a pre-qualification letter that will allow you to place offers on properties with a pre-qualification. Getting pre-approved, there's a few more steps. So the next kind of mini step after getting your loan application submitted will be getting pre-qualified. The one good thing about getting pre-qualified is now once you're at that point, you and your real estate agent will get a hard price point, let's say $200,000 or $200,000 to $210,000. So something really solid. You guys can actually go out and start looking for homes at that point with the pre-qualification. Now, the lender's still going to need some more documentation and things to get you, quote, pre-approved. And let's dive into that here right now. So let's talk about what it takes to get actually pre-approved for your loan. Like I just mentioned, the lender is going to need quite a bit more documentation from you to get a full pre-approval. And many lenders won't actually give you the pre-qualification letter to submit offers until you get this document in. So it's really a good idea to be ahead of the game and get this done. Not only that, but if you don't do this ahead of time, you'll be scrambling during your closing process and your contract process to get this documentation done, and it can end up holding up the closing date of your deal. First thing the lender's going to want is your most recent pay stubs for the last 30 days. Now, if you're a business owner or you work on 1099s, they're going to want to see that as well. So the other thing that the lender's going to want is they're going to want to see that you've had consistent income coming in for the last 2 years. So they're going to want either W-2s if you're an employee, or they're going to want to see 1099s for the last 2 years. And the main thing they're looking for there is continual income coming in, like no lapses, like you didn't have a job for 6 months or something like that. In addition to that, the lender's also going to want to see your federal income tax returns for the last 2 years to ensure that you've been actually paying your taxes and things like that as well. Now, the lender's also going to require a government-issued photo ID. Usually you can just use your driver's license, passport, or like I said, government-issued ID card. And lastly, the lender also wants to know kind of what kind of capital you have. So they're going to want to see your last 2 bank statements and also your last 2 investment statements. So if you have like 401ks and things like that, investment statements and bank like savings account statements, just so they know what kind of capital you have in the bank right now. So as you can see, getting pre-qualified and getting pre-approved are 2 pretty different things. Getting pre-approved is what you need to do. So the best way to start off your transaction is to do that ahead of time, but you can start looking for houses and everything once you're pre-qualified. So one other thing to note, typically your pre-approval is going to last 120 to 180 days, because at that point, once you get past like the 120, it depends on the lender, but once you get past that mark, then they're going to have to rerun your credit score just to verify that things haven't changed in that amount of time. All right, so awesome. We've got you now pre-approved, and the next step in this process is to just go out and find your home, okay? So in this step, you'll be out searching and looking at homes with your realtor and getting into contract. As soon as you get into contract, you're going to start your 10-day inspection period with them, where you're going to be getting inspections done and working on your repair requests with your agent. So also what's happening during this time is a few other things with your loan. First thing is the lender will reach out to you to sign the initial loan disclosures. Once this happens, that's when your loan processing begins. The processor works with your loan officer kind of in the background, while all this other stuff is going on. They start processing all the documents you've provided them during the pre-approval process. The processor also is just gathering information and getting all the documents they need ready to get your loan set up for final approval. Now that loan disclosure, the lender will send that out as soon as escrow is open. So that's why it's really imperative to get that earnest money deposited like the next business day right after you open up escrow. And in that disclosure, it will talk about your intent to proceed through with the transaction, and it'll also give you your loan payment estimate, which is really important because it's going to tell you your monthly payments are going to be. So the next part of this finding your home step is that you're going to get your homeowner's insurance. So you are going to be required to get homeowner's insurance to get fully approved for your loan and get full underwriting done. Now, some lenders will actually recommend or have homeowners insurance companies available for you to use, or you can use your own. Whatever the case is, now's the time during this inspection period, the first 10 or 15 days of your contract, is to get that ball rolling and get that homeowners insurance account set up. One other thing that the lender is also going to be doing kind of in the background as well is they're going to be ordering title insurance. Title insurance is an insurance policy that the lenders require that the buyer is usually responsible for paying as part of their closing costs unless they negotiate it with the seller in the purchase offer. But it's an insurance policy that covers the borrower or the lender in the event that there are any liens or clouds on the title that would cause a hang up in the title being transferred to you as the buyer. So all that stuff, when we were talking about finding your home, a lot of that happens in the first 2 weeks of your contract acceptance. Now, after that, the next thing that's going to happen is the appraisal is going to be ordered. And typically, the lender's standard is to wait until after the inspection period, because there usually is an expense to the buyer of about $500 or $600 to order the appraisal. But it depends on how the market is doing and everything else. It can be ordered earlier. The appraisal is God, so several things can happen with that. They're going to come out, they're going to look at the property, run the comps, see what the other properties are worth, and they're going to come up with a value of what the appraiser says the home is worth. And again, appraiser is God. There's really no arguing with them. If the appraisal does come in low, say the house was $200,000 and it came in at $195,000, the seller can either drop the price or you can come up with the cash to make up the difference between $195,000 and $200,000, or you guys can meet in the middle. One other thing to note is you can get out of the deal if the appraisal does not come in at the purchase price. So once the appraisal has been negotiated, if it comes in under, then if it does come in under and say that the price has dropped from the $200,000 to $195,000, then the lender is going to probably have you re-sign the initial loan docs to reflect the change in the price. Additionally, the appraisal may require additional inspections or repairs done by the seller. For example, in Arizona, it's very common to have termite inspection done. And if there are termites, then the appraiser is definitely going to call those out. Additionally, things with the VA loan, those guys are going to be looking at trim on the houses. And again, if those weren't called out in the inspection period, then the appraisal, it'll be given conditional on those repairs being made by the seller. So the seller may have to do additional repairs to get the appraisal to give a full appraisal. So once the appraisal is done and the loan processor got all the documents and everything they need from you and everything's processed, it goes to the underwriter. And the underwriter is basically like the gatekeeper who goes over the whole entire loan, all the documents and everything, and basically gives the rubber stamp of approval, which is the final loan approval. Now, underwriters can do what's called a conditional approval, and that means that the loan is approved financially with some conditions. So for example, if there was some trim work that needed to be painted on the house as part of the appraisal, then that can be a condition that would hold up the final loan approval. So the loan would be approved pending that repair work getting done. Another thing that can give you a conditional approval would be like they're still waiting on your W-2 or something like that. So that's why it's super important at the beginning of all this to make sure that you get all the documents as soon as possible to your lender. That's like the number one thing. Congratulations, you've got your loan final approval. So once you get final loan approval, the lender will issue you a copy of the closing documents, which you must review and sign, and it must be done 3 days prior to the close of escrow. So don't delay in this. Get those closing documents reviewed and signed and sent back to the lender ASAP, because it can delay the closing, which is a bad thing. And just when we thought we were home free, right? The lender is going to do one final check / re-verification of your employment status and your credit. So remember earlier when I told you I was going to talk about one of the biggest pitfalls that cause first responders to lose their home deals and lose thousands of dollars in earnest money and fees? Remember that? Well, I'm going to tell you what that is right now. So one of the biggest pitfalls that new buyers run into all the time is that they change their status financially during the contract. So what I'm going to tell you right now is a couple things. Don't change jobs. Don't buy anything with a credit card. That includes like new furniture for your house. I know you're excited to get the new refrigerator and the new couch, but just wait till after closing. Do not put anything on a credit card and do not finance anything. You cannot change your financial status negatively in the eyes of the creditor during the contract, because it will cause your loan to become not approved, and then you are in breach of contract, you lose the house, you lose the earnest money, and you lose any fees or anything else you've paid. So it's super important not to do those things while you're in contract. It's closing time. It's closing time. So the lender is going to send all your approved documents to title. Once they do that, the title company and your realtor will schedule a time for you to come in and sign all of your documents. Any additional funds that you may need, like a down payment or any other closing costs that you owe, will be due at that time via cashier's check, or it could be wire transfer if you're not local or the title company is. Ideally, that signing appointment will be 1 day prior to close, or it could be the morning of the closing day. Once you get all the documents signed, the title company will reach out to the lender and say everything's signed, and then the lender will send the money and fund your loan. So the loan will fund and go to the escrow account. Once the loan funds and all the documents are signed by both parties, then the deed records. The title company will record the deed with the county, and once that happens, you'll get your keys. So just a quick recap. We went through the entire loan process as it relates to your buying purchase process. They all kind of intermingle, but just to a quick review, we first got our loan approved, then we got into contract, and during that time, you sent in all your documents, the loan got processed, the appraisal was ordered, and once we got through the appraisal, then your loan went to underwriting and it got final approval done. So now that you've learned more about how your home loan plays into the entire buying process, watch the next video in this series where I'm going to dive into even more home buying tips for first responders. Thanks for watching.